Here is a detailed summary of the FedEx Q3 Fiscal Year 2025 earnings call transcript, designed for clear and concise delivery. Good afternoon, and welcome to the FedEx Corporation's third quarter fiscal 2025 earnings call. Opening remarks and CEO's perspective. Raj Subramaniam, President and CEO. Raj Subramaniam began by expressing profound gratitude to FedEx team members for their exceptional performance during a challenging Q3. They successfully navigated a compressed peak season, severe weather events, and the expiration of the U.S. Postal Service contract, all while prioritizing safety and customer service. Financial highlights and performance. Revenue growth. FedEx reported a 2% year-over-year revenue increase in Q3, marking the first revenue growth of the fiscal year. This was driven by higher volumes at Federal Express, partially offset by FedEx Freight. Profitability. Adjusted operating income saw a significant 12% increase year-over-year, reaching $160 million higher. This improvement was attributed to the combined impact of revenue growth and substantial cost savings. Adjusted EPS outlook. The company has lowered its full-year fiscal 2025 adjusted EPS outlook to a range of $18 to $18.60, down from the previous $19 to $20 guidance. This adjustment reflects an uncertain demand environment and higher than anticipated inflationary pressures. Drive savings. The Drive program continues to deliver strong results, with $600 million in savings achieved in Q3, bringing the total year-to-date savings in line with expectations. The company remains on track to achieve its incremental target of $2.2 billion for FY25 and a total of $4 billion from its FY23 baseline. Federal Express performance. This segment delivered strong year-over-year results, with adjusted operating income up 17%. This was achieved despite headwinds from the USPS contract expiration and severe weather. Revenue increased 3% driven by higher volume in deferred services. FedEx Freight performance. This segment faced headwinds from lower volumes, fuel surcharges, and reduced weight per shipment, resulting in a 5% revenue decline. Operating profit declined by $80 million year-over-year, though base yield improvement and cost management partially offset these challenges. Gross margin. While not explicitly stated as a single percentage, the company highlighted a 60 basis point expansion in adjusted operating margin year-over-year, demonstrating improved profitability despite revenue pressures. Management's forecasts and future outlook. FY25 outlook. As mentioned, the adjusted EPS outlook has been revised to $18 to $18.60. The company now expects FY25 revenue to be flat to slightly down year-over-year. Q4 expectations. For the fourth quarter, FedEx anticipates essentially flat revenue at Federal Express, driven by continued volume growth in deferred services, partially offset by one fewer operating day. FedEx Freight is expected to see continued revenue decline year-over-year, but with sequential moderation. FY26 considerations. High-level. While specific outlook will be provided in June, management anticipates annualized benefits from current Drive initiatives of approximately $400 million. They expect continued inflationary cost pressures and some headwinds from the USPS contract for the first 4 months of FY26. Network 2.0 savings are expected to ramp more significantly in FY27. Significant risk factors. Uncertain demand environment. Weakness in the industrial economy continues to pressure higher margin B2B volumes, particularly at FedEx Freight. Inflationary pressures. Higher than previously expected inflation on the cost base is impacting profitability. Global trade policy uncertainty. Evolving trade policies and tariffs could create further uncertainty and impact global trade flows. Severe weather events. The company continues to be exposed to the impact of severe weather, which can disrupt operations. USPS contract expiration. While managed effectively, the loss of the USPS contract represented a significant headwind, the impact of which is easing. Key highlights: successful peak season, delivery of strong results within a compressed timeline despite challenging conditions. Drive savings momentum, continued sequential build and drive savings, on track for full-year targets. Network transformation progress, resumption of Network 2.0 conversions, and progress in optimizing stations and Canadian rollout. Tricolor initiatives are improving asset utilization, with a 9% increase in air network payloads and a 5% improvement in density. Europe performance, encouraging improvements in Europe with simplified technology driving operational efficiency and profitable share growth, on track for $600 million in drive savings from the region. RouteSmart acquisition of RouteSmart Technologies to further enhance route optimization solutions for global network transformation. Healthcare vertical growth, onboarding nearly $400 million in new annualized healthcare revenue over the next 90 days, with significant business tied to bundled customers using the FedEx Surround Suite. Sunday residential coverage expansion, expanded Sunday residential coverage to nearly 2/3 of the U.S. population, with incremental commitments for over 0.5 million packages per week. Capital allocation, continued reduction in capital intensity with $2.5 billion in share repurchases year-to-date, and on track to return $3.8 billion to shareholders in FY25. Planned FY25 CapEx reduced to $4.9 billion. Fleet modernization, agreements to purchase 8 new Boeing 777 freighter aircraft and 2 used ones, at attractive prices, to manage the fleet long-term and retire older, more maintenance-intensive aircraft. FedEx Freight separation, progressing well on the separation of FedEx Freight, including a successful $16 billion debt exchange offer. Lowlights: lowered EPS outlook, the downward revision of the full-year adjusted EPS guidance due to macroeconomic weakness and inflation. Continued B2B weakness, the industrial economy's ongoing pressure on higher-margin B2B volumes, especially impacting FedEx Freight. Revenue decline at FedEx Freight, the segment experienced a revenue decline due to lower volumes and weight per shipment. Most important statements from management: Raj Subramaniam, CO. They delivered a strong peak within a compressed timeline and managed weather events ranging from unprecedented wildfires to severe winter storms. They accomplished this with a focus on safety and customer service, and I am very appreciative of their dedication and success. Taken together, these two factors, revenue growth and drive savings, enabled us to achieve 12% adjusted operating income growth compared to last year. We are creating a more flexible, efficient, and intelligent network. By the end of FY25, about 12% of our average daily global volume will flow through Network 2.0 optimized facilities. I'm excited about our transformation progress as we continue to integrate our networks, reduce our cost to serve, and enable better performance. Looking ahead, I'm confident that our transformation initiatives such as Drive, Network 2.0, and Tricolor will create long-term value for our stakeholders. We have established Drive as our operational framework, which will be beneficial for us moving forward. Additionally, we have built a robust data infrastructure that acts as an enabler, differentiator, and value creator. John Dietrich, CFO. Our Q3 performance demonstrates our team's strong commercial execution and our rigor in reducing structural costs. On a year-over-year basis, we grew adjusted operating profit in Q3 by nearly $160 million, or 12% despite headwinds. As a result, we delivered adjusted EPS growth of 17%. Given the ongoing challenges in the global industrial economy, inflationary pressures, and the uncertainty surrounding global trade policies, we now project FY25 adjusted earnings per share to be in the range of $18 to $18.60. We expect to exit the fourth quarter by achieving our FY25 goal at an annualized drive run rate north of $2.2 billion. We continue to significantly reduce capital intensity while returning capital to shareholders. We completed approximately $500 million in share repurchases in Q3, bringing the year-to-date number to $2.5 billion. From a fleet standpoint, we recently reached agreements to purchase 8 new Boeing 777 freighter aircraft and 2 used 777 freighters. These modern and fuel-efficient aircraft were purchased at attractive prices. Brie Carrere, Executive Vice President and Chief Customer Officer. Consolidated revenue increased 2%, driven by higher volume at Federal Express, partially offset by freight. Ground volumes increased 7%, supported both by B2B and B2C growth. As we look ahead, we expect FY25 revenue to be flat to down slightly versus last year. We continue to build unique capabilities for our high-margin healthcare vertical. We are onboarding nearly $400 million in new annualized healthcare revenue over the next 90 days. From a market and a pricing environment perspective, it's always competitive, but it's been rational. And honestly, I think if anything, we've seen improvement in the environment throughout the fiscal year. This concludes the summary of FedEx's third quarter fiscal year 2025 earnings call.